Good evening. My name is Rob Misey, and welcome to our continuing series on the international tax provision of the 2017 Act. Tonight I'm going to talk about the deemed repatriation regime. And I like using that phrase instead of what it's also known as the transition tax. Why do I not like the transition tax? It reminds me of my baseball coach telling me he was going to transition my role on the team. Well, I was already batting ninth and playing right field. So my transition was to the bench to get a bunch of splinters. So I'm not that fond of calling it a transition tax. It's a deemed repatriation regime. Previously, we talked about the participation exemption. The participation exemption for C corporations, and C corporations only, allows the exclusion of a foreign dividend. Theoretically, the transition here was to clean out the E&P to prepare everybody for the participation exemption that began on January 1st, 2018. However, just like me getting transitioned to the bench, there's bad news for non-C corporations because non-C corporations get stuck with this tax, but they don't get the benefit of the participation exemption when they receive dividends in the future. It's not a good deal for them. Well, what is the tax rate on the deemed repatriation? To the extent you have cash and cash equivalents, it's 15.5%. Any remaining E&P is 8%. When do we determine the E&P and when do we determine the cash and cash equivalents? There are different dates. E&P is determined the greater of either on December 31st, 2017, last day of the year, or November 2nd, 2017, the date the Act was introduced in the House. Cash or cash equivalents are the greater of either the amount on December 31st of 2017 or the average of the 2015 and 2016 year ends. So here we have U.S. Co. owning foreign sub. Foreign sub has $1 million in cash and $2 million of land. Obviously, land is not a cash or a cash equivalent, and $3 million of E&P. What is going to be the tax? The tax is going to be $315,000. $155,000 at 15.5% on the cash of $1 million, and the land, the non-cash or cash equivalent E&P at 8% for $160,000. Now, in this situation, we had a C corporation, and they do get a deemed paid foreign tax credit, although that also gets a haircut. But what happens if you're not a C corporation? Say, for example, you have an individual owning the foreign sub through the LLC. Once again, you're going to have $315,000 of tax. Are you going to receive any foreign tax credits? No, you are not. Well, thank you for joining us in this presentation. Look forward to seeing you next time. Have a great rest of the day.